So what do you look for when you look at an equity?
Well, a couple of things. First, we tend to lean more towards broad ETFs and indexes than specific stocks. However, every now and then a stock just develops a series of metrics that are so appealing that we feel compelled to step in. I'll give you a perfect example. A couple of quarters ago, we bought Walmart. Why Walmart? Well, we had no retail exposure because we haven't been impressed with what the consumer's been doing. But Walmart, despite a couple of minor scandals and things, was holding up really well. The stock in 1999 was trading at a very high PE. It's a very low PE multiple. The stock had a nice dividend now, and we raised our expectation for, look, we never know when a recession's coming, but we try and put a probability on it. And we went from, because of the overall trend in employment was sliding down, and a number of other factors made us concerned about a possible recession in 2013. What happens during recession? Consumers tend to throttle back and they start to look at discounted shopping. So BJ's,
the better Walmart does, the worse the economy does.
Very often it's a warning sign when you see Walmart. And now Walmart is at 10-year highs, is at levels it hasn't seen since before the dot-com crash. They seem to be hitting on all cylinders. I don't pretend that I'm a retail analyst, but I can certainly look at a company like Walmart and say, hey, this is doing really well. All the numbers are there, the fundamentals, the technicals. Compare that with a broader index. So as we own one of the biotech indexes, XBI, I can't pick a biotech stock to save my life. Half of them go out of business. The other half are waiting for the FDA approval. I have no insight into that. But I have to tell you, I know that the population in the United States is aging. I know that due to a combination of genomics and a variety of other technologies, there are all sorts of new molecules and all sorts of new treatments down the pipe. I can't tell you when we're going to be taking a little piece of tissue and growing our own liver or heart or whatever the organ is, but that's somewhere out there in the future. And rather than try and guess which of the 2,000 companies that dabble in that space are going to get it right, we buy the whole index. It's dominated by the 20 biggest companies in that space. It's been doing really well, and I expect it to continue doing well for the next couple of, I don't want to say decades, but it should certainly profit from the demographics.
This gets to one of your ways of doing things, and that is you said, don't pick the stock, get the asset allocation right, and you'll do okay.
That's right. You know, study after study has shown that determining the asset classes you want exposure to, stocks, fixed income, commodities, real estate, is going to have a much bigger impact on your total performance over time than picking any specific stock. The world's greatest stock picker in 2008 got shellacked, and any monkey could throw a dart in 2009 and make a ton of money, as long as you had exposure to the right asset classes, and that means less equities when you're in a nasty downturn, like we saw from the end of 2007 to the March of 2009. More bonds during that period, you'll do well. We've also seen, look at 2011, equities essentially flat. Bonds did fantastic last year. So you have to be aware, and again, this comes back to the Fed. If the Fed is doing their Operation Twist, if they're buying bonds, I'm pretty sure that bonds are going to end badly once the Fed stops this program, but I can't tell you if that's next week, next year, further out. They've already told us they're going to keep rates low to 2014.
So you have to dance until the music
Till the music stops, and which is, by the way, that's a really dangerous game, as Citigroup learned when they used that quote. You have to be a little suspect. It also means you don't have to eliminate fixed income exposure, but you probably don't want to buy the 30-year at 2.4%. So we keep our duration relatively short, 4, 5, 6 years. Ideally, you build a ladder, and as each year comes up, hopefully you're replacing them with higher yielding bonds. The only risk when you do that is if yields are going up, it probably means that inflation is peeking its head out. So that becomes a very difficult situation for the Fed to navigate. So we're trying to navigate around them, then navigating around the possibility of inflation. Not easy.
So what made you turn relatively bearish?
Well, 60% equities, 40% bonds, not terribly bearish. It's the expectation that this has been a very artificially driven economy and a very artificially driven equity market. We had the 800
like
billion
baseball on steroids,
to say the least. I mean, when you start seeing 65, 70 home runs, it's telling you something. Market's up 100+% in 3 years. That's the best run we've seen since the 30s, after the great crash in '29. The economy is just hanging below stall speed. 1.5% GDP is nothing to get excited about. Stop and think about the massive amounts of government activity to just keep at stall speed or just above. You have the stimulus, you have Operation Twist, you have massive Fed activity, you have lowest rates we've ever seen, 0% for God knows how long until this ends. And the net of that is, as Reinhardt and Rogoff had written, after a credit crisis, we should expect to see subpar GDP, weak job creation. They pretty much forecast exactly what happened.
You made reference to 66 to 82. Mm-hmm. Where are we in this bear cycle?
It's such an instructive period. You start 1966 at 1,000, you end 1982 at 1,000, only they had massive inflation over the middle. So even though you're essentially flat, you effectively have lost 75%. That 16-year period saw a crash and a recovery. 73, 74 was the big crash and a recovery. I would say that's very parallel to what we experienced 07 to 09. Here we are 3 years later, which would put them somewhere in the 77, 78.
So we got 2 more to go?
One more major correction. You know, Bill Gross's Death of the Cult of Equities is, to me, parallel. It's getting us closer to the end of this. It's parallel to the famous Business Week cover in '79, Death of Equities. Now, if you bought on that cover, you were a couple of years early, but you really didn't get beat up too bad over the next 2 or 3 years. The 79-80 recession took about 25–30% off equities, and the next recession is going to be, in my hopes, I don't even want to say opinion, my hopes, the next great buying opportunity. Everybody tends to look backwards. You know, we tend to see what just took place. The fear is of another 57% collapse. Statistically, the odds are against that. We already had that major crash. So the next regular cycle, I know it's hard to imagine, but one day we'll be back to a normal business cycle. We'll occasionally have the Fed raise rates. They'll occasionally cause recessions, and those recessions will cause 20 to 30% market corrections, which historically have been great entry points for the longer-term investor.
So going back on the bonds, as you say, you don't know when the thing is going to happen, but you know it's going to happen. You once compared it like a person dying. It may take a long time, but then it's sudden.
Yeah, there's a great line from a movie. It was sudden. Oh, she was dying for years. Well, at the very end, it was sudden. I look at bonds today, especially 10-year and 30-year treasuries, the way you could have looked at dot-com stocks circa 1998. Truth be told, you knew the momentum was going to carry it further, and you expected it was going to end badly, and if you were honest with yourself, you would admit you had no idea when that's going to happen. Well, that's where we are with bonds. Yields are probably going lower. I wouldn't be surprised to see 1.25 on the 10-year. Wouldn't shock me. I have no idea how long this is going to go for. I don't think we're Japan. I don't think it goes on for decades. But I think everybody is going to recognize that when this ends, it's going to end badly. And people who have too much exposure to bonds, stop and think about this. We've had a 30-year bull market in bonds. If you would have plowed into equities at the end of the last 18-year bull market, you got beat up pretty badly. The NASDAQ down 80%. I don't think we'll see that happen with bonds, but eventually yields can't just go in one direction forever. It's been a long, long time to get from, where were we, 16, 18% in the early 80s down to 1.5% on the 10-year.
So you're not totally bearish now. So what other stocks do you like? You mentioned ETFs.
So let's see what else we have. We've owned ConocoPhillips for a while. We've owned Walmart for a while. We're very happy with the Biotech index. That's worked out pretty nicely for us. We had JP Morgan, which we got rid of half of it on the announcement, which gave up all our profits and a little more, and so now we're completely out of the position. We have emerging market dividends. We have the S&P 500 dividend portfolio has worked out. We have a Hathaway. Berkshire Hathaway is one of our bigger holdings. It was our worst performer last year. It was down about 3 or 4%. This year, it's just been a house of fire. I call it the faux housing recovery, the apparent housing recovery, only because we don't have all these foreclosures and distressed assets in the mix, so it makes the prices look better. They're just normally 20 to 30% lower than the adjacent property. Berkshire is really well positioned to take advantage of that. They have a huge position in Wells Fargo, so that's our financial exposure. I think the fear of Berkshire without Buffett has been a little overdone last year, and now he's got a clear path to someone else running the company when he's gone. But they've assembled just a massive set of assets. It's one of not only the best run companies in the country, but you look at the assortment of assets, it's just really well geared to take advantage of whatever the next recovery looks like.
So you're fairly fully invested, even though it's
60% equity, 40% bond, and maybe there's a little bit of cash in that mix, you know, less than, we really don't like to go 100% cash, so maybe there's a little wiggle around those numbers. Maybe it's about 10% cash, somewhere around that. We're pretty close to the benchmark, but we were heavily overweighted equities in the beginning of the year, in the first quarter, and so we've throttled back from that. The expectation is there is something untoward coming our way. We just can't tell if it's the end of 2014, the end of 2012. If you look at the market rallying the past few weeks, if you look at how there's been some upside, some of it's Fed-driven, some of it's a modest improvement in the economy. Every time there's the expectation that we're going to fall off the cliff, we just never quite go into that stall. You know, you drop a little bit, people get nervous for a few months. It's exactly what we should expect in a post-credit crisis environment. Weak GDP, soft employment.
So ultimately, it's preservation of capital.
It's, oh, you know what? When you're in a secular bear market, we talked about 66 to 82, you know, you have to switch hats when you're in what we define as a secular bear market, which I define it as a period of time where the psychology is so bad that investors are willing to spend less and less for the same dollar of earnings. They just have been beaten up too much, and that's how you get ultimately to that low, like 1982 with a PE of 8 and everybody hating equities. We're almost there. You know, we're probably just a few years away, and your job during a secular bear market, manage risk, preserve capital. Yeah, you could be opportunistic when various situations come along, but my goal is to get to the next 1982 with enough capital preserved so that I could switch hat, and then my goal becomes maximizing gains. But we're nowhere near that period.
One last question. Romney versus Obama, who wins and what difference will it make?
Well, I'll answer the second question first. I don't think it makes much of a difference. I'll tell you what we're seeing now, the difference in anticipation is that we're seeing people take capital gains off the table. If you have a nice property, if you have an expensive condo, a summer house, you want to get rid of it because you're going to see your capital gains go up. We're starting to see a lot of that take place now. There's a mad dash before December 31st to close a lot of deals, a lot of transactions. I think whoever wins, we're going to see our taxes go up. I don't care what either of them say. You know, we're running these huge deficits. Spending is going to be cut. Taxes are going to go up. That's likely the outcome. I think you can look at what equity markets do from now until October. That run before an election, if the markets roll over and drop, the factors that underlie that usually work to the challenger's advantage. On the other hand, if the market rallies into October, the factors that underlie that usually work to the incumbent's advantage. what's surprising about this election, on the one hand, this sitting president should be really easy to defeat, should be the easiest incumbent to knock off just because of the general state of the economy. On the other hand, this challenger has a very tough electoral college to get past. I suspect Romney will win Florida. Pennsylvania, Ohio, Virginia are going to be where the elections are going to turn. Virginia is going to be tough versus an incumbent. And I kind of get the sense that Romney shot himself in the foot with the GM comments. Wisconsin, Ohio, Michigan, that didn't play well there. He's got to win 2 of the 3 of those other states. Ohio, Virginia, Florida, that's the election, those 3 states. If he takes 2 or 3 of those, he wins. Right now, before naming a VP, before the convention, before that big momentum bump, it doesn't look like he's going to take 2 of the 3 in August. Now, you ask me the same question in September, and it could be a very, very different answer.